There's nothing substantive to this rally. It is not supported by the fundamentals. It is simply noise. You're seeing bear market rallies. That's it. And they're going to come to an end. But one of the trends that I do think has legs, and it's something that I have been predicting, is that foreign stocks are outperforming domestic stocks and emerging markets are outperforming developed markets. Because if you look at what's happening so far internationally, global stocks are up, I think, about 8.5% on the year, which is ahead of the 6% rise in the S&P 500. And if you just look at emerging markets, there you're up about 10%. So that's better than the developed foreign markets, and again, much better than the S&P 500. So we are still seeing a continuation of the move from domestic to foreign and from developed to emerging markets. Those trends, I also believe, will continue throughout the year, as will the move into gold and gold-related equities. That is also happening. Gold is up about 6% so far on the year, which is matching the return on the S&P 500. But if you look at gold stocks, the GDX, even though it wasn't even up this week, is still up 12.8% so far on the year, which means gold stocks are beating the NASDAQ. But the bigger difference between the rally in gold stocks and the rally in the NASDAQ is, I think, not only is the gold stock rally sustainable, but it's going to accelerate. I think these stocks are going to rally even faster later in the year than they are right now. Whereas the rally in the NASDAQ is completely unsustainable. I think we're going to reverse, and before too long, NASDAQ stocks are going to be lower on the year. I think the same thing is going to be true with the U.S. bond market, which so far on the year, bonds are also rallying. So you've got a rally in stocks and a rally in bonds. But this follows one of the worst years in history for the stock and bond market combined. So we are getting this bounce. But I expect that the rally in bonds will be just as short-lived, maybe even more so than the rally in stocks. And in fact, potentially, I think bonds could have a worse year in 2023 than stocks, although I think tech stocks, the NASDAQ in particular, will fare far worse than the overall averages, because I think the rotation that started last year out of momentum-type stocks is going to continue this year. But really what's driving the move up in both stocks and bonds is the weakness in the economy, because we continue to get more weak economic data, and not just weak economic data on the economy, but there's still hope that inflation has peaked, and the lower numbers that we've been seeing when it comes to month over month or year over year inflation rates, that this trend is permanent, and therefore the inflation battle is over. The Fed can declare victory and start cutting rates and easing up on policy. All of this is what is creating the narrative that is driving this move up in both stocks and bonds. But I think as the year progresses, it's going to be more obvious that inflation hasn't peaked, that the Fed is nowhere near victorious in this fight, and the economy is actually going to be even weaker than the markets think. The markets think the economy will be weak enough to restrain the Fed, but not so weak that it puts a big dent in corporate earnings. They're wrong. The economy is going to be much weaker than investors think, and it's going to have an even bigger impact on earnings than investors think. But inflation is going to be much higher than anybody thinks, and that is going to really complicate the situation for both the Federal Reserve and the economy. I still think that in 2022, the real increase in prices was north of 15%, which means if we accurately measured prices to determine the deflator for 2022 GDP, we would have in fact seen a massive contraction in the economy. That's what's actually happened. The government is covering it up by cooking the books, but in reality, the economy is shrinking. And that's why consumer sentiment is so low. The economy is not growing the way the government claims. It is shrinking. It only appears to be growing because the government is lying about the numbers, and the media is helping the government get away with it. In fact, the main reason that we even had the increase in GDP in the back half of 2022 was the improvement in the trade deficit. The trade deficit was still huge, just not as huge as before. And there were some temporary factors that helped reduce the trade deficit. One was the strength of the dollar. Well, the strength of the dollar began to reverse sharply in the fourth quarter of last year. And in fact, year to date, the dollar is down again. The dollar index is down about 1.5% so far this year. In fact, we closed below 102 with a 101 handle, 101.92 to be exact. And so the weakening dollar is now going to worsen the trade deficit. Also, the trade deficit was impacted positively by oil exports because we had all the oil that was released from the Strategic Petroleum Reserve that we were able to export. We're not going to be doing that in 2023. So the trade deficits are going to be getting bigger, and that is going to be subtracting from GDP. In fact, at the same time that we got the GDP numbers for Q4, the government also released the trade deficit for December, and that deficit came in worse than expected, and it represented a significant deterioration from the November deficit, which was originally reported at 83.3 billion. It was actually revised to an even smaller 82.9 billion, but instead of December coming in at 88.5 billion as had been forecast, it came out at 90.3 billion. So worse than expected, and an even bigger increase over the prior month than had been expected. On a month-over-month basis, imports increased by 1.9%, while exports fell by 1.6%. And if this is any indication as to what's likely to happen in January with trade deficit, this does not bode well for GDP going into the first quarter. In fact, if you look at the Atlanta Fed's current estimate for Q1 GDP, it's all the way down at 0.7. And I think by the time we actually finish Q1, we're going to end up with another negative quarter, just like we had a negative quarter in Q1 of 2022. However, I don't expect to see a stronger back half of 2023 the way we saw in 2022. I think the U.S. economy is going to get progressively weaker as the year goes on, and I expect the second half of 2023 to be even worse than the first half.